Good morning, everyone, and thank you for joining today's session that's been organized by the TRA.
Good morning, everyone,
and thank you for joining today's session that's been organized by the TRA.
Good morning, everyone,
and thank you for joining today's session. Sorry, there was a little bit of a technology glitch, so I had to mute my tablet. So good morning again, and thank you for joining today's session organized by TRA and TRA Virtual Academy. I hope everyone is keeping safe, your families and friends during this pandemic. My name is Namet Tahan. I work for Dell Technologies based out of Dubai. Before I will start, I really want to thank and appreciate the TRA and TRA Virtual Academy for their efforts and this great initiative to spread the knowledge in the region around different topics. I think this is great, especially during this COVID-19 time. I think it's really beneficial for everybody to be aware because I think we are getting into the new norms that we're still trying to discover what these new norms are. Let me give you a bit of context on what we're going to be discussing during today's session. The topic is called Beyond Banking. And if you really want to imagine what that may look like, let me give you a bit of perspective on how the session is going to go today. During the first half an hour or so, we're going to be discussing the trends, the challenges that banking or financial institutions are facing or started facing recently, and they're still going through that. And then we're going to be discussing the role of technology, and in particular, infrastructure technologies to helping banks evolve to become more disruptor rather than being disrupted. So without a further ado, the digital future is really happening today. We no longer have to wait for years to see the digital future that we're going to be seeing. If you look at the way we work, the way we commute, the way we interact, the way we relate to each other, they all have been redefined by technologies, right? We no longer have to go and visit a branch to do something with the bank. We no longer have to wait for things to happen. The mobile have really changed the way we do a lot of stuff. This was like a pre-COVID-19. Now with COVID-19, the new norms is going to be even more digital, more remote, more virtual. So therefore, technology would really play a major role in enabling that. This is for us as people, this is how our personal life has been redefined, and businesses are no different. What we're going to be seeing more and more coming our ways is we're going to start seeing more partnership with machines. And what I mean by machines, I mean artificial intelligence, machine learning, deep learning, and these would really shape and reshape the way we even think. And it would allow us to surpass our own human capabilities to do things that we could never do before. To the business, there's no different because we are one of the driving force that really like moving and pushing for transformation in almost every single business that we think of. So every organization needs to be digital, powered by data, which is the new oil, and running in a multi-cloud world. So there are three keywords here: digital, data, and multi-cloud. And I'll be expanding on those as we go through. It's really hard to think of any industry that is not being disrupted or still going through disruption due to the mobile, social media, cloud, and big data. We started seeing new business models invading the incumbents. So if you take a look, for example, at education, it's no longer you have to be within a class to learn something, but really what yet to come is the personalized e-learning. Like what sort of information I need as myself that would relate to my experience, that would relate to my own aspiration to be able to learn more. So it's not just about the virtual, augmented reality, virtual reality. It's going to be way more beyond the boundaries of our thinking. Take a look at hospitality. Today, hotels are being disrupted by the Airbnb and likes. Take, for example, at the personal styling. Today, a lot of companies are using data and data scientists to tailor and custom tailor what you're going to be wearing or what you like to wear using analytics and big data. Take a look, for example, at the automobile industry that is being disrupted by autonomous cars, driverless cars. And banks are not immune to this. Actually, banks were one of the last industries to be disrupted, or financial institutions in general, due to the heavy regulation that exists today in the financial industries. Someone can say that financial industries, due to their importance in our lives, are the most regulated industry in the world. But that wasn't the case till recently, when we started seeing disruption coming from everywhere, and we started seeing newcomers invading the financial institutions' businesses. This survey, what you're seeing on the screen, is a study was done by PwC. It's called FinTech Survey 2017. And in a response to a question, who would most likely be the disruptive force in the next 5 years in the financial industries, only 28% think that traditional financial institutions, the banks and the insurance companies, would be the disruptive force, while 75% think the fintech companies and the startups would be the most disruptive force in the financial industries. 50% think ICT companies and large tech, the Apple, the Google, they would come up with more interesting products, capitalizing on their innovation and the technology knowledge that they already have within their house. Other thing that social media and internet platforms would be the most disruptives. Here, throughout the presentation, I'm going to be focusing on two things: the traditional financial institutions, because I truly believe the banks have the know-how and they have almost everything they need to be the disruptive force here, especially as we started seeing in the recent years. They started doing some partnerships with fintechs. Fintechs realized that we cannot do it alone, so they shifted their focus from business to consumer to business to businesses and started creating partnerships with banks. And the same thing for banks. They started thinking that we cannot do it alone, so we need to create some sort of partnerships with the fintechs. So let's take a look at the history of the financial industry and technology throughout the years and see what sort of opportunities they created together, and they were able to produce new products throughout the years. So let's take a quick look at the finance and the technology. In the 1950s, we started seeing, or we saw the first credit card came to life. And if you can imagine what that created in our lives, basically, it expanded the consumer's power in terms of spending. You no longer have to go to a bank to get a loan. Using your credit card, you can start spending money that you don't have, and then you pay the banks on installments. In the 1960s, that was a big year. To be precise, it was 1967 when the first ATM machine came to life and started operating, and that was a big thing in the world back then. Actually, if you read about it, the slogan of that advertisement for the first ATM machine was "the bank that never closes," which means that 24/7 you can get your money out of the bank, and that was a big thing in 1960s. 1970s came, and then we started seeing electronic trading. So we moved away from books trading into electronic trading, and that also created a massive impact to the markets and the way we trade and exchange stocks in the stock market. Come 1980s, we started seeing the mainframe, and the banks were one of the greatest adopters of mainframe, where they started the first step toward digitizing their business. So the potential that mainframe created for the banks was massive due to their capabilities, and the pre-mainframe to the post-mainframe era, where banks started realizing the benefits of the technologies. 1990s, if you're old enough to see the bubble that was created by the 1990s, the dot-coms, the e-commerce, the business to consumer, consumer to business. It was also massive opportunities for banks to start capturing that kind of market. Until the year 2000, we started seeing the internet banking and the mobile banking to come into life. So today we all have mobile apps on our tablets or iPhone or Android or what have you, and we can do a lot of stuff using our mobile digital banking applications. What we're going to be seeing towards beyond 2020, we're going to start seeing more digitization, but that digitization will change. So if you take a look at the last 65 years between financial and technologies, we can call it like 65 years of peace, where banks have always leveraged the technology to their advantage, to creating new products, creating new revenue streams. And what is striking, that the banking sector was never felt threatened by technology throughout the last 65 years. Until we have a turning point, which was 2008, where the financial crisis hit the market and consumers, almost like a lot of people, lost their trust in the banking system, and they started looking for alternatives. So since 2008, you can say the relationship between the financial and technology started to drift away, and we started seeing what we call the rise of FinTech. So FinTech is not something new that just came out in 2008. FinTech has been there, which is the merge of financial and technologies together to create new products, new possibilities for both. But what we started seeing beyond 2008, we started seeing an attack from the FinTech companies. Basically, these are technology companies offering financial services, if you want to put it in a simple term, where they started looking at the bank and they started unbundling the bank. And I'll explain this in the next slide, what it means to unbundle the bank. But what is interesting, the FinTech industry today remains to be the most attractive industry for investors, where more than $150 billion already poured into the FinTech industry. And that is expected to grow beyond $355 billion beyond 2022. So in a couple of years' time, we're going to see that number almost double due to the attraction of that industry and the possibilities that FinTech creates in the market. So if you take a look at this is according to the Venture Scanner. You can see the latest FinTechs there. They track more than 2,500 FinTech companies that operate in different areas of the banking or the financial industries. Consumer remains to be the number one industry where FinTechs are really active on. So if you take a look, for example, here, this is not conclusive. This is just a few companies that are listed here. The category where they are listed is the interesting piece I want to draw your attention to. It's hard to find a FinTech company because they're startup, they're small, they're niche, operate in more than one or two areas of the financial industries. So for example, it's hard to find a company that operates in consumer lending as well as business lending. You always find them operate in one company and one area, and that is what I mean by unbundling the bank. So the areas of disruption in the bank are mainly taking place in the consumer banking. This is us. Fund and transfer and payments. This is again us, because consumers demand to transfer money for a fraction of what banks charge them today. You don't expect someone who's transferring $100 to his family somewhere in the world to pay $50 transfer fee. So consumers are demanding a more efficient transfer fees. At the same time, they're demanding an instant transfer. So today you can transfer money using your iMessage if you're using iPhone, or if you're using Facebook in the US, you can transfer money through the Messenger. This is the kind of requirements or features that customers are demanding from their banks. But looking at the bank's costs, looking at the bank's regulations, these are things that banks find it hard to do. So the areas, the top four areas of disruptions are taking place in the consumer banking, funds transfer and payments, investment and wealth and management, and small to medium business banking. This is what I meant by unbundling the bank, because these areas of the disruptions are being attacked by the fintechs. But the greater disruption, not only coming from the fintech, that was just the technology part, where we said fintech is technology companies providing financial services to the consumers. The greater disruption continued to come from new regulations, and this is where you tend to see a lot of uncertainty about regulations around privacy, around mandating the banks to open their platform for third parties. So this will continue to evolve. And as I always say, innovation cannot be stopped by just like stringent regulations. Regulation will always have to catch up in order to keep up with innovations. We started seeing also some macro global environments changes that also impacted the banks. We started seeing new business models coming into effect, challenging the incumbents, not only in the banking industry, but almost in every other industries. The easy entrance to a new area is almost non-existent. Today, you can set up a bank in less than 24 hours, providing that you have the license. And there are companies that can sell you a bank as a service. We started to see also some more digitization in the ecosystem. And again, this has accelerated post-COVID-19. So almost today, even every single little shop that you used to buy grocery from, they have a digital and mobile app where they allow you to purchase without even going to the supermarket or to the shop. Open banking was one of the biggest trend. And today, if you look at what's happening in Europe, late 2015, early 2016, the European Parliament, they have passed on a bill, what they call it Payment Services 2 Directive, which basically mandated the banks to open their data for third parties. Let me give you an example why this is important for us as consumers and why it's important and challenging for banks. I will talk about this in the coming slide, but just quickly. So basically, for example, if you have a payment application from XYZ company on your mobile app, you can link that to your bank account, and your digital payment company can authorize payments from your account directly without going through a credit card, without going through a PayPal, and what have you. So that created a new challenges for the bank, but at the same time will create new opportunities, as we're going to see throughout the presentation today. Digital payments, if you can just imagine the amount of money that is being transacted over digital platforms outside the banking industry, this can be in trillions of dollars every year using digital payment platforms like the PayPal, the Alipay, and the localized payment system as well. Last but not least, customer intelligence and personalization at scale. And to me, if there is one theme I'm seeing today in every business that needs to be disruptive, that needs to survive, that needs to thrive and capture new market share, capture new market potential, personalization is about everything. If I don't get what I'm expecting as a person, if I don't expect my bank or my service company to know me the way who I am, where I spent my money, how I spent my money, to know my habits, to know my behavior, they will never be able to provide me with that customer, with that personalized service. So personalization is a key theme of everything digital is happening around us. So to that extent, with the power of mobile, there was a study was done by the financial brand where they expect a major decrease in the by 36% between 2017 and 22. The number of banks visits would decrease from basically by 36%. What that means to banks no longer need to have branches. On the other side, they expect a 121% rise in mobile transactions, which means digital, digital, digital. So therefore, bank need to step up in order to create that personalized experience to the consumers. So let's pause here and take a bit of reflection. A new business model empowered by digital is what every industry is going through, what every industry is going to go through, especially when it comes to the business to consumer, or in some cases, business B2B or business to businesses. According to IDC, by 2021, at least 50% of the global GDP will be digitized. Let's quantify this and what that means in terms of what is the 50%? How much is it in dollars? If you take a look at the world GDP today is ranging between 85 to 90 trillion dollars. So that 50% represents about 45 trillion dollars will be digitized. That means creating a new growth opportunities in almost every single industry driven by digitally enhanced offerings, operations, and relationship. And what is interesting, for any investor to invest in a company or in a startup by 2020, which is basically this year, and I can say that has already started like in the last 2 years, investors will use platform, data value, and customer engagement metrics as valuation factors for all enterprises. Let me again pause here and give you shed some more lights on this one. The way we used to invest in the past, we used to look at the company to see how much they're doing, how they're selling every year, what is the earnings to price, what is the assets, and then we decide whether to invest or not. But this is changing because we're going digital. We're going to a platform-based economy where data is valuable and customer engagement is valuable. How sticky that platform is to customers makes a lot of difference. So platform, value of data, and customer engagement are the three new metrics that investors would use to invest or not to invest in a company. Let me quantify that again and give you some real-time examples from the stock market. So what I have done here, if you look at the top 3 bars, these are platform-based businesses. The middle one is called DP, that is a digital payment company without naming them. And the last 3 are traditional banks. They are some of the largest global banks in the world. So what do these numbers mean? If you take a look, for example, at the first platform company, it's called P1, and you'll see a figure of 117. Because the investors are so enthusiastic about the business model, about the platform, about the data, about the stickiness of that platform, investors are willing to pay 117 times the earning per share. So what does that mean? If this company is earning $1 a share, that means I'm paying 117 times their earning because I know these guys are growing, they have a great platform, they know how to monetize their data and what have you. The second example is a very similar, but at a smaller scale, but customers are paying and they're willing to pay 132 times for this company because their business model is unique. So let me give you an example of what this company does. Basically, they connect artists, craftsmen, small businesses, excuse me, to consumers, and yet they don't own nothing. The way they have been operating over the last 4 years, they have shown a massive growth. The way they have done their platform is an amazing, create stickiness between the consumer and the producer. The third example is an example of a company that is like a retailer. They own no single inventory, they own no single product, and yet in one day they can transact over their platform over $34 billion worth of transactions. What they do, they just connect consumers, in a simple term, they connect consumers to producers, and they are the middlemen. Look at the middle one, which is a digital payment company. This is an emerged digital payment company. They do nothing, but again, they transact payments. Investors are paying 98 times their earning per share. The bottom 3 are the top 3 banks in the world, where customers are only willing to pay 11 times their earning per share, 10 times and 9 times. These are the top 3 banks in the world. So you can imagine, now you can see how investors are valuing the new business model or the platform economy or digital platform economy. So what are we seeing here? Are we seeing like just a technology shift or a business model shift, right? You may want to guess, but before you do, let me just take some for examples. If you take, for example, Uber, many of us think that Uber is a taxi company. In fact, Uber is the world's largest taxi company, and yet they don't own a single taxi. Airbnb, we know what Airbnb is, right? The world's largest accommodation provider owns no real estate whatsoever. They don't even own a single room. All what they do, they connect people like us who are willing to rent their apartments out to people that are willing to take it. Take, for example, Facebook, the world's most popular media owner creates no content. The content that we create are published on Facebook. Another example of Alibaba, one of the world's most valuable retailer, owns no inventory. So the common theme across all these 4 mega companies is the platform business model, leveraging technologies, leveraging digital and innovation in the business model. So take a pause here and ask the question, will the future bank become a platform? Or can the future bank become a platform business? Before we answer that question, let's look at what the definition of a platform is, right? And that's very important for us to be on the same page. A platform basically is a plug and play business model that allows multiple participants mean producers and consumers, to connect to it, interact with each other, and create and exchange value. So think about the platform producer and interact and exchange values, right? So first and foremost, the platform is a business model. It's not just a technology trend, right? It's a business model. A platform must enable participants to easily engage and disengage. What that means in the technology world, it has to be based on an open source. It has to be based on APIs. And last but not least, it has to create value. It has to add value. 1 plus 1 has to equal more than 2. Otherwise, there is no need for the platform. How do you execute the platform strategy? First and foremost, you have to be a magnet. Magnet means it has to be sticky. The experience you get on a platform will decide whether you are going to return to that platform or not. And this is something we do almost on a daily basis. We do a lot of research to buy something or to do something. Before we take that transaction, we do some research on reviews. If you like the reviews, we do the transaction. If you don't like it towards our personality, we may never come back. So that magnet has to be there. The platform has to act as a matchmaker. Matchmaker means, today if you go to a single, whatever you want to call it, any platform, you'll find tons and tons of things that you can do or you can buy. But without knowing you, without knowing your behavior, without knowing your purchasing habits, without knowing your size, without knowing your gender, you could never act as a matchmaker and match my requirements to what's available on that platform. So this is very key, and this can only be leveraged by the power of data. API. API stands for Application Programming Interface, and this is basically how the producers can interact to the platform, developing applications using a well-published API from the platform producer. I'll touch on this as we go through that when it comes to relationship to the banking industries. Let's ask the question again. So will the future bank become a platform, or will the future bank can become a platform business model? So now let's look at the options. So we looked at the definition. We said mainly it's a plug and play, it's a business model, and it has to be sticky, it has to act as a matchmaker. So let's look at the options that the banks have today, and now you start relating what banks are doing. The first option is about digitization. And today we started seeing a lot of banks digitizing their traditional products using mobile apps. So what that means for us, I no longer need to go to a branch to open an account. I no longer need to go to a branch to get a loan. I no longer need to go to a branch to do some basic transactions. So that is basically the first and the most simplistic approach, digitizing the traditional services using mobile apps. And most banks are doing this today. It's really hard to think of a bank that don't have a digital product today, whether it's an online or saving account or credit account, checking account. The next approach or the next option would be taking that digitization to the next phase. And this is what we call it the open banking platform. Here, banks would focus on creating an ecosystem around their platform using open banking. What that means is that banks would start publishing APIs for third parties to come into their platform and start developing services. But these are mainly related to financial services. They don't go outside the financial services. If they want to proceed to the platform business, they need to go beyond banking. And that's basically the topic of our presentation today. Will banks go beyond banking? In my own view, not every bank will go beyond banking. Some banks may decide to go beyond just offering financial services to becoming a single-stop shop for their customers. So basically, you can do almost everything you want on the beyond banking platform, from booking tickets to booking hotel rooms to paying your dentist bill to paying, organizing almost everything in your life around the platform. This is where the banks go outside the financial services and they start becoming a platform-based company or platform-based business outside the financial industries. Now, the question is, will every bank go beyond banking? The answer is definitely no. Will every bank go open banking? Most likely. Will every bank digitize their products? 100%. Should you become a platform? That would be great. Should you become a product of that platform is also great. So beyond banking concepts, for banks even to collaborate with each other. So if you have a credit account with Bank A and a checking account with Bank B, the beyond banking or the open banking will allow you to interact between these two banks using the same single platform. Starting from open banking to beyond banking would require setting up a lot of partnership between the fintechs, between the telecom provider, between almost every single touch points that customers deal with. Not every bank would have to go beyond banking, but every bank would need to go digitized, and most likely the top banks would go open banking, and we started seeing this coming to life even where we live. So it's not just a technology play. To be able to digitally transform a business, basically you need to focus on the 4 key pillars of digital transformation. First and foremost, again, you have to have that innovation mindset. And this is not a one-person job, it's every person in that organization's job. You have to have that agility and decision-making and adapting to change. You have to have a data-driven decision-making. It's not about what you know, it's about what you can know about something to make a decision. You have to implement agile development, and this is completely different to the waterfall development methodologies that we used to have in the past. You need to implement microservices to be able to act like a Facebook, trying to, or basically being able to launch new services, enhance offering twice a week, twice a month, not once every 6 months using the traditional methodology. Most importantly, you have to be customer-centric. You have to know your customer. KYC is know your customer. Without knowing your customer, without being able to analyze sentiments, without being able to implement artificial intelligence, machine learning, deep learning, you would never be able to personalize that customer experience. To the far right is the technology play or the infrastructure play, and that I'll be focusing on during the next minutes. Here, we need to talk about what sort of infrastructure would allow banks to deploy all the features and characteristics that an open banking platform would require. Here we're going to talk about cloud, multi-cloud. We're going to talk about native cloud applications. Most importantly, secure and trusted. To the bottom, it's the mindset and the culture and the people. And these three things, they play a very key role in being able to transform your business to become digital or to become more open in the open space. Touching a little bit on the customer centric, because to me that's very important, driving that personalized experience. Banks need to master the data. If you think about the amount of data banks have today, so basically in a simple term, my banker knows where I go. They know where I spend my money. They know the set of places and the class of places I go to. They know what I buy. They know what almost everything about my financial life, right? The question is, how much is the bank monetizing that data today? I'll tell you, right? Today, it's really hard to get a message on your mobile from your bank that makes sense to you. They may send you a message saying it's time for school fees. We can give you this facilities to pay for the school fees. But the fact you're not even married, or you don't have children that go to schools. So there's no personalization. It's just a mass marketing. And if the hit rate gets to 10%, most banks would be happy with that. But this is changing. Customers have to focus on the 360 view, customer view in one place. Today they have 360 view, but scattered all across the place, and it's really hard to correlate between my credit card experience and my saving account transactions and what have you. Stronger segmentation, this relates to the 360 view. Banks also need to really segment their customers based on who they are, based on the gender, based on their spending habits, based on their income and what have you, to be able to drive that personal experience. For the sake of time, I'm not going to be touching on each one of them, but in real time, banks have to go do risk analysis and assessment. Sentiment analysis is very important. Today, some banks have implemented using the face detection available in the CCTV cameras to measure the sentiment of a customer when he walks into the account and when he leaves. Was he happy using his face expression? Was he not happy? Because today, most of our experiences are done based on emotions, and emotion plays a big part of the decision making that people do. Fraud and threat detection is also a very key area where banks have to also master the data to compare benchmark normal to what's abnormal, and then take a decision based on that detection. Moving forward, I'd like to borrow a quote from Scotia, the CEO of Scotia Bank. This is one of the top banks in the world, and I think this sums it all. He said, "We are in the technology business. Our product happens to be banking, but largely that is delivered through technology." Go back to what I said when I spoke about the fintech. The fintechs are technology companies delivering financial services. So now that shift in the mindset of the banking industry, they realize that we're like the Uber. We don't, have taxis, but we deliver transportation services. The same thing for the banks. They realize for us to be innovative, for us to be able to drive that digital experience with our customers, we have to act like a technology business. We have to act like a technology company with innovation in-house. They realize that innovation cannot be bought, rather innovation needs to be developed within the bank in order to drive that competitive edge compared to other banks. So to that extent, IT would play a major role in enabling that technology adoption in the banking industry. IT must deliver competitive advantage. Software DNA is very critical. Banks have to act like a software house to drive innovation and to drive that personalized experience. We can no longer buy off-the-shelf software and expect to be different than others. Rather, it has to be customized, personalized to your customers, and that can only happen in-house. So let's make the statement. Digital transformation will drive IT transformation. It's not the other way around. I will not transform IT and then wait for digital to happen. We have to drive the agenda between digital and IT. So taking this slide, look at the right side of the slide where we talk about the open banking. So for banking to become open and become like a platform-based business, IT needs to look like the picture on the left. We need to have all these layers within the data center or within the operating model, using either private cloud or public cloud or public cloud. And so basically we need to operate what we call it a multi-cloud architecture. To get there, we need to focus on the infrastructure. We need to modernize the infrastructure. We need to look at the application landscape and modernize it. We need to look at our operating model because what worked in the past will not work in the digital future. So let's touch on these three aspects quickly for the sake of time to leave some time for questions. These are the three pillars of modernizing the IT in order today to gain that competitive edge and allow the business to become digital. On the application front, we have two types of applications. We have the traditional where we need to optimize. Cloud native, this is the new way of developing applications. So basically we need to rationalize the application portfolio and build cloud native apps if they're new. On the technology, we need to implement a platform for infrastructure as a service, platform as a service to support both traditional and cloud native apps. So this goes hand in hand here. Anything traditional will operate on infrastructure as a service. Anything new will operate on platform as a service. Last but not least, which is a very important part of the transformation journey, is around the people and the way we operate our IT. So looking at the application landscape, we have like what we call it the application factory. So every application needs to go through that kind of factory. Existing applications would go through these steps. If you can repurchase, the first choice would be to purchase software as a service, because that would be the first or the quickest way to implement something, using software as a service from one of the software as a service providers. If cannot be repurchased, then we need to rewrite, basically refactor it on build new using PaaS, CaaS, or infrastructure, and that can be hosted in a public cloud or private cloud, depending on what the best landing zone might be. If cannot be, then you need to re-platform, means make it more portable and put it in a container. If that is no option, rehost, lift and shift. Basically, you can break that application, host some pieces in the public cloud or private cloud, and shift the other to a modern infrastructure as a service platform. If that is no option, then retain it as is using either a virtual or physical infrastructure. If that application can be retired, that's basically the last option to have is retire the application and make sure that you keep the data for compliance. Any new application, as I said, these are the steps or the preferred ways of implementing SaaS. If that would be an option, if not, then develop using cloud native apps. So these are the 5 or 6 steps that banks have to go through, looking at their entire application landscape to make sure they are modernized and they optimize the cost of running these applications and invest in new apps. Data centers also evolve. So from an infrastructure point of view, according to Gartner, by 2022, 60% of enterprise IT infrastructure will focus on centers of data rather than traditional data centers. What does that mean? That means data placement is basically, or application placement, of finding the right workload, the right place for that workload is going to be the focus of the IT. The role of IT in the future will become to manage a global infrastructure. It's no longer bound to a single data center boundaries. It's rather spread across data center, private cloud, multi-cloud, where it's become more global. So the end result will be an environment focused on enabling the rapid deployment of business services and deploying workloads to the right place. So the end result basically will be to allow the business to deploy services as and when needed, IT can no longer become the barrier for the business to deploy new applications. Otherwise, they will create what we call it a shadow IT, and the business will start using public cloud without even the knowledge of IT. That's very important from an IT perspective. So today, if we take a look at what's happening in the today's data center, we still have more than 30% running on legacy, 60% virtualized, 8% still in infrastructure as a service, and 2% PaaS. What we're going to start seeing, more shifts towards the infrastructure as a service. And for your information, the main difference between virtual and infrastructure as a service, which is IaaS here, is automation. Virtual is just taking the application and bringing it on a virtual machine, while infrastructure as a service is a fully automated, service-driven, using self-service portal and chargeback, fully automated, orchestrated, running in a virtual network. It can be running on converged or hyper-converged environment. So that shift towards infrastructure as a service is what would allow the IT to move to a consumption model versus a construct model. The consumption model is basically where I build that service for the business to consume without the burdens of the current processes and the change process that we have today. It's built on a self-service, fully automated, and orchestrated infrastructure. We're also going to start seeing more adoption of platform as a service. This basically implies to the cloud native apps where applications are born in the cloud, applications are developed for the cloud to leverage the cloud infrastructure. So ending up operating a multi-cloud strategy would require us to create a consistent operational experience across the private cloud, on-prem, the public cloud somewhere, and the edge. Think of it like a branch office in a banking environment. That consistent experience is very critical. Or we would end up building silos, but this time not within the data center, silos spread across the globe, if you think about cloud as also being a silo. So having that consistent infrastructure and consistent operation is very key to operating a multi-cloud environment. The reason why I'm saying this, if you go back 20 data center from a single place or single pane of glass. So take that today and apply it to a multi-cloud environment where things can be on-prem, off-prem, and the edge, and the cloud, and the core. Without having that single consistent infrastructure, we would never be a consistent operation. We would never be able to scale and provide the business with the things that they need to innovate. So the outcome of what I have been discussing on the IT transformation piece would be something like this. The business is faced with a service catalog, self-service catalog, can either provision infrastructure as a service resources or PaaS and CaaS services depending on their requirements. What will decide on where these resources would land is not just cost, it's not just agility. It is security, compliance, cost, performance, and data sovereignty. So for example, banks today have some regulations and some compliance that they need to comply with. Some customers' data cannot leave the country. So definitely public cloud, outside the country is definitely not the right landing zone for these kind of applications. If you have security concerns and you don't have trust in the public cloud security, these applications have to be within your data center. So to the left is what we call it the on-prem data center, where it can be virtualized, can be cloud native, or it can be normal modernized three-tier architecture. To the right is the leverage of the public cloud. So that view is what we call it a multi-cloud enabled IT as a service, where it's built for consumption, where it's built for immediate consumption from the business as and when needed. That kind of agility is what would allow the businesses to basically implement a digital strategy that would allow the businesses to implement applications that will allow them to go to market as quick and as needed. So to conclude on, so basically this is the last slide in my presentation. Some key takeaways and best practices going through the IT transformation piece. Transformation is a top-down change agenda. IT would never be able to transform the business. In fact, it's coming from top-down, and that would reflect on almost every single aspect of the business. During transformation, you have to execute in multiple and concurrent work streams. You can't go sequential, you have to go parallel. You can't wait for one to finish and then take on the other. It's rather concurrent work streams. Therefore, a level of governance at every work stream is required to make sure that someone is overseeing the big picture going through the transformation. From an application point of view, modernize the entire portfolio, but one bite at a time. You can't do it all at once. IT infrastructure cannot drive this. IT would need to involve the application owner and the businesses. These are the people who own these applications, and they need to be carried along during this transformation journey. Avoid build it and they will come. This used to be the old concepts when you build software. Build it and they will come will never get you where you want to be. Make sure that customer is always at the heart of any development you do. From a technology perspective, make sure that everything is software defined, so you can have the abstraction layer to the hardware infrastructure, and that will give you to drive agility in the IT infrastructure. The network piece is often the hardest. Therefore, software-defined network is also a key requirement in IT transformation across the WAN and the LAN and the SAN. Try to minimize cost spending for recovery. Using virtual today, you don't need to have multi-site recovery and at the data center level. On the operating model, it's as important as the other components: automation, automation, automation across all levels, infrastructure as a service and platform as a service. So to conclude on this, transformation is not a destination, it's rather a journey. And that journey has to be well governed at all levels. So with that, we come to the end. I hope that you find this useful, and I hope I was able to pass on the message about the importance of the transformation, how to be the disruptor rather than being disrupted by other incumbents. So with that, I think we can take some questions. If we still have time for so, we still have, I think, some 7 minutes. Let me go through if there's any questions here.
That's organized by the CRA.
Team, I don't think we have any questions coming unless the team from TRA. So there are no questions. I think we can conclude. So with that, I really want to thank you for taking the time to join the call today, and have a great day and stay safe.